You know, I've always felt that there's very little benefit from a learning perspective in showing trades that cruise to profit easily. You know, you can do everything right in a trade and you can still have one that does not work out, right? This is why I always talk about risk management being vital to any success that you're going to have long term. I want to show you a trade. And in this trade, everything lined up really, really well. I just didn't get the follow through that I wanted. And before I dive into this trade, if you could hit subscribe there, I'd appreciate that. Like the video. And at the end, if you have any questions or comments, pop them below. And this is going to be a trade in HOG, man. It's the daily chart. And I want to cover all the essential factors that made up this trade. So I'm going to start with trade setup, trade entry, and then we'll get to trade management. And the first thing is we had a big move, right? So it was positive earnings. And you can see that price shot up, had a gap, and it broke resistance. So after a big move in price, we'll often see price do a few things. We'll see some form of consolidation pattern form, or we can quickly reverse the move, right? And there's variations of how those can all play out. But the bottom line is when we see a big move, we expect something else to happen. So a question you should be asking right now is, well, what's a big move? You can certainly use a technical indicator to measure momentum and looking for a big move in that indicator in relation to previous readings. But you can also just look at the chart and ask yourself if this current move is different than the recent past. Now, if you want an objective measure, which is fine, right? Stick to a momentum indicator until you can train your eyes to really see the difference of what a big move is. So after this big move, consolidation or pullback. And yeah, you can absolutely just click the buy button into a momentum move. The problem is you just never know whether you're buying the high of the move. Even if you just wait for a 1 day pause in price and just play the breakout, your odds of success, or at least some price movement in your favor, is just a little bit better. But so in this case here, we actually started to see a bull flag or a triangle pattern forming. Now, you don't know which one it is, right? Because both of these patterns are going to start off looking pretty much the same. The main difference really is the flag pattern is going to have a lower fourth swing. And I say 4, but this can take different formation. But generally, you're going to play both of these chart patterns the same way if you trade it the textbook way, which would just be a breakout of the upper line or some variation of that. But you can also play a bounce off the lower lines as well, because those do act as a support zone, that price zone. And a knowledge of some candlestick patterns can really come in handy when you're looking to trade at the bottom of these zones in an uptrend. One of the keys when we're trading the flag pattern is we do not want to see momentum during this corrective move. Now, we can see momentum come in, and if it does occur, we would like to see a small consolidation before entering. But generally, when we see a pullback, we would like to see some lazy price action. So far, just to recap, we had a large move to the upside, and then we see a formation of a pattern. We don't know what it is yet. Eventually turns into a bull flag. And that bull flag is actually a complex correction, right? It has 2 legs to the downside. So the setup part of the trade is complete. And now we have to focus on how we're going to enter it. Now, there is a lot of ways you can enter a trade, all right? From the hook of a momentum indicator to a smaller time frame break. You want to have a few that you can use to give yourself every opportunity to enter a trade, and then be consistent with the few that you're choosing. Okay, we do not want to knee jerk into trades. So before I cover the entry that I used, I just want to go over a few options that you can use, and it depends on your schedule during the day. With these options, I just like you to test it out within the framework of your own trading strategy. You can enter near the close. So about an hour before market close, just go through the tickers that you're interested in trading, right? You see their conditions and you put them on a potential entry list. So in the case of HOG, price had hit the bottom of the channel that made up the bull flag and was heading into the close pretty strong. And that's not always going to be a great way to enter. There have been times where price just turns around on the close, right? And close on the lows in those last few minutes. Rarely does that happen, but it can. You have to be aware of that. Now, this shaded area on that daily candle, that's the price movement inside the last 30 minutes of the session, right? So the candle was strong going into the close, and it actually ends up closing near the high of the session. So a trade entry inside the last 30 minutes with a protective stop loss at the lows, that's a potential entry for you depending on your schedule. But if you have some time in the morning, you can always look for an opening range breakout or some other technique for your entry on a lower time frame. So if price is trading near the potential reversal point on your session, right, traders may decide to keep that chart front and center for the trading day on the list of tickers that they're watching. Now you need to define what that entry zone is for you, right? So for one trader, it could be a structure support or resistance zone. Another trader may use a fib level or a trend line or the edges of a price pattern, right? It's a little bit more aggressive of an entry, but it does get you in a little closer to where the price reversal occurred. So talking about buying breaks, this is a 30-minute chart, and let the first 30 minutes pass by. Right? You read the price action. So this day it opened with a gap down, and then we had a strong 30-minute reversal, placing a buy stop order for a break of the high of the 30-minute range and a stop loss at the low of the day, viable trade entry. And once the entry and that stop are set, you can get on with the rest of your day, whatever your day is. Just let the market do the work. You've limited your risk, you have your entry, and some days you're not even going to get triggered, all right? But your protective stop is set, you're good to go. We can also have break of resistance. And this entry, you can set it up near the close of the session, or you can do it in the morning of the session when the price is in your zone. And it's a little more hands-off at first, but it does give you the opportunity to adjust your entry depending on the session. So here you see the strong close, the potential close of the candle. So in order for an uptrend to resume, we have to start seeing higher swing highs. So on a lower time frame, you'll often see a downtrending structure of lower highs and lower lows. So your trade entry can go above a nearby price pivot. Then when it breaks, will be a new high. So whether you set it up in the morning or the previous day near the close, the first pivot break here would have been at the zone labeled number 1. Now this gap down that did happen, it did place that entry a fair distance from the open. And that's a sign that we could have another pivot form in the morning. So at number 2, we get that new pivot form, right? As price start to pull back. And it's actually around where the opening range breakout entry was. So a trigger puts in a higher high with a higher low formed, and that's our structure uptrend. The stop loss will go around the low of the session. And for this, I generally use a 30-minute chart to set levels when I'm setting up a swing trade, or I will enter near the close of the session. Rarely do I touch the market during the session when I'm swing trading, and that means in the middle of the day. First 30 minutes is fine and near the close. For this trade that I did in HOG, and mainly because of this gap down, I used the opening range breakout on the 30-minute chart, and the stop was just a little bit underneath the low. Trade triggered, and it was underwater pretty quick. And when the markets are in this current environment, I usually set tight targets of 1.2 to 1.5 R with a stop loss, obviously. And I manage that stop. So with this trade, my thought was I would at least see price test the second high in the pullback, the potential target. Well, after 2 days of higher closes, the day ends red. So I adjust my stop to break even, right? I'm not going to take a 1 hour loss. The second day, price puts a marginal new high in, and I just put the stop loss under the green day. Then we get a consolidation day, right? So we just keep the stop where it was. And the next day, the price hits my stop and I'm out of the trade. And I would have been a lot better off just taking the profits at an R multiple. And people will ask, well, can you be profitable with 1.5 R trades? Yeah, you can. Even 1 R trades can work well over the long term. And I know a lot of traders have that 1 to 3 risk reward ratio drilled into their heads. But if you adjust stops when price is not advancing in your direction, rarely are you going to take a full position loss. In fact, you are going to have many more 1 hour winners than you will the higher rewards of, 3s and 4s. Really, there are a lot of trading truths that are in fact just suggestions. So I wanted to do this video just to give you some insight on this trade because there's a lot of interesting things to learn from it. I hope you liked it. If you like these kind of videos, let me know. Put it in the comments below. They'd like to see more of these kind of videos. Make sure you hit subscribe, like the video, and we'll talk to you soon. Thanks for watching.